Hello everyone, I am Manisha Jailath. We are group number 50. So we are going to present about a comparative financial statement analysis of two prominent Sri Lankan companies, Stringa Sri Lanka and Abans PLC. So let me begin with a quick background on both companies. Abbas plc, founded in 1981, is a well-known diversified conglomerate in Sri Lanka. While it started with the focus electronic retail, it has now expanded into manufacturing, real estate, logistics, IT solutions and financial services. Its wide-ranging presence in local market makes it a significant player in the Sri Lankan economy. Singa Sri Lanka, on the other hand, has a much longer history, dating back to 1877. It originally started by selling swing machines, but today it is a leader in the consumer durable like home appliances and furniture. Singer is known for its strong brand, extensive distribution network, and customer focused approach. In this presentation, we will compare the financial performance of both companies using key ratios such as profitability, liquidity, gearing, and efficiency ratios to assess their financial health, operational efficiency, and long term sustainability. Our objective is to understand which company performs better financially and what insight can be drawn for improving corporate financial management. Let's begin the analysis. So, I'm Amaya. So, let's see profitability ratio. Profitability ratios measure financial performance of a firm. Some of the popular profitability ratios are gross profit ratio, operating profit ratio, net profit ratio, return on capital employed, return on equity. First, gross profit ratio shows the percentage of sales remaining after deducting the cost of goods sold. It reflects production efficiency. Operating profit ratio measure the percentage of profit from the core business operations before in interest and taxes. It indicates operational efficiency. Next, net profit ratio. Net profit ratios shows the overall profitability after all expenses including taxes and interest. It reflects the firm's ability to generate net income from sales. Return on capital employed. Return on capital employed measures how efficiently the company uses its capital to generate profits. A higher return on capital employed means better use of funds. Next, return on equity indicates how well the company generates profit from shareholders' equity. It shows the return earned on invested capital by owners.
I am Situ. Today I will be comparing the financial performance of the Singer and Abbas based on two key profitability ratio of gross profit ratio and operating profit ratio. Gross profit is a profitability that expresses the company gross profit as a percentage of total sales. Starting with the gross profit ratio, Singer has a higher gross profit ratio of the 24.25 compared to the Abbas to 22.57%. This indicates the Singer is a more efficient at the generating profit from its sales because accounting for the operating expenses. Both companies are above the 20 marks, which generally signals good profitability and effective pricing strategies in their respective industries. Operating profit ratio is a refer to the ratio they use to define the relationship between operating profit and the net sales. However, when we look at the operating profit ratio, we see the difference. Abbas outperforms Singer significantly with the ratio of 12.5%, while Singer is just 5.15%. This means that Abbas better at the meaning is operating expenses or has a higher operating margins, lead to more profiting from every dollars of revenue after accounting of cost of like salaries, rent and utilities.
I am Jude Camillus. Let's start with the net profit ratio. Aban showcases a robust net profit ratio of 7.03%, indicating a strong ability to convert revenue into actual profit. In stark contrast, Singer lags significantly behind with a mere 1.11%. This stark difference highlights a major profitability gap. Abans is clearly more successful at turning its revenue into profit, while Singer may be grappling with high cost of operational inefficiencies. This is a critical area for Singer to address if it aims to enhance its profitability. Next, we turn our attention to return on capital employed, a vital metric that measures how efficiently a company is utilizing its capital to generate profits. Abans reports an impressive ROCE of 22.52%, which is nearly double that of Singer's 11.98%. This significant disparity indicates that Abans is far superior in leveraging its long-term capital to derive earnings. A higher ROCE suggests that Abans is not only generating more profit from its capital, but it's also likely to attract more investors looking for efficient capital utilization. Lastly, we examine the return on equity, which provides insight into how effectively a company is using shareholder funds to generate profits. Once again, Avance leads with ROE of 0.8% compared to Singer's 16.52%. This means that investors in Avance are receiving almost double the return on their equity compared to those investing in Singer. A higher ROE is a strong indicator of financial health of effective management, making Avance a more attractive option for potential investors.
I am Ashini. Now let's dive into liquidity ratios, a key aspect of assessing a company's short-term financial health. These ratios help us understand how easily a company can meet its immediate obligations. In this section, I will explain the two main liquidity ratios, the current ratio and the quick ratio, and what they tell us about a company's financial stability. Here, Singer has a current ratio of 1.2 while Abans is higher at 1.44. This means Abans has more current assets to cover its current liabilities, showing a stronger short-term financial position. About the quick ratio, when inventory is excluded, the quick ratio drops to 0.75 for Singer and 0.94 for Abans. Although both are below the ideal benchmark of 1, Abans is again in a better position, suggesting it's more capable of handling immediate liabilities without relying on selling inventory.
I am Janithan. I am going to explain leverage ratios. Leverage ratios are used to calculate a company's long-term financial positions. They are mainly classified into three categories: debt to equity ratio, debt to total assets, interest coverage ratio.
Debt to equity ratio. The debt to equity ratio is financial metric that indicate how much a company relies on debt financing compared to equity financing. In our example, single debt to equity ratio is 2.16 and above debt to equity ratio is 0.17. In according to the ratio, single carries much greater leverage than high long-term risks, while Abbas light debt load offers safe, more resilient capital structure. Debt to total assets. Debt to total assets ratio, also known as a debt ratio, measure a company's financial leverage by solving the proportion of its assets that financed by the debt rather than the equity. Singers 0.88 and Abbas 0.56. Singer is far more debt load and therefore riskier, while Singer low ratio signals a strong balance sheet.
So let's see the interest cover ratio of these two companies. The interest cover ratio measures how easily a company can pay interest on its outstanding debt. In this case, Singer has an interest cover ratio of 2.33, while Abbas has higher ratio of 3.54. This means Abbas is in a stronger position to cover its interest expenses from its earnings. A higher ratio indicates better financial stability and less risk of defaults. So Abbas is more secure in managing debt obligation compared to Singer. Let's see efficiency ratios. These ratios are used to evaluate how well a company is using its assets and resources to generate revenue and profits. There are four main types of efficiency ratios we focus on here: stock turnover ratio, receivable turnover ratio, accounts payable turnover ratio, and asset turnover ratio. These ratios help us understand how well a business is managing its operation to maximize revenue while minimizing cost and delays.
Hi, I'm Prakash. Let's look at two important financial efficiency ratios, the stock turnover ratio and receivable turnover ratio. First one, the stock turnover ratio. The stock turnover ratio of Singer is 264.49 and Avance is 138.78. This ratio shows how efficiently a company manages and sells its inventory during the year. Singer has a higher percentage here, but higher is not always better, unless we consider the number of times inventory is turned over. When we convert these figures into turnover times, Abbas turns its inventory over about 2.63 times per year, while Singer does it only about 1.38 times per year. So Abbas is faster and more efficient at converting inventory to sales. It holds inventory for around 139 days, whilst Singer holds it for much longer, 264 days. Holding inventory for fewer days means lower storage costs, fast cash delivery, and better cash flow. So Abbas demonstrates better inventory management, which contributes to operational efficiency and cost savings. Second one, receivables turnover ratio. The receivables turnover ratio for Singer is 232.48 and for Abbas 53.91. This ratio helps us understand how quickly a company collects payments from its customers, converting these to days outstanding. Singer takes approximately 232 days to collect receivables. For Abbas, it takes only 54 days. So, a longer collection period at Singer indicates slow cash inflow and may suggest weak credit policies or loose customer payment terms. Abbas, on the other hand, demonstrates strong credit control, faster collection, and improved liquidity. So, Abbas is in a much stronger position when it comes to cash management and credit policy enforcement.
I'm Tisri Taruka. Let's look at the asset turnover ratio and accounts payable turnover ratio of Singer and Abbas company. The asset turnover ratio measures how efficiently a company uses its assets to generate revenue. In this case, Singer has a slightly higher ratio of 1.00 compared to Abbas with 0.96. This means that for every unit of asset, Singer generates slightly more revenue than Abbas. So overall, Singer is more efficient in utilizing its assets, which is a good indicator of operational performance. Next, the account payable turnover ratio. The accounts payable turnover ratio is
financial metric that measures how quickly a company pays its suppliers. Singer's ratio is 2.34 while Abbas is higher at 3.75. A lower ratio suggests that Singer is taking about 232 days to collect its receivables, which may indicate slow collection or lenient credit policies. In contrast, Abbas collects within around 54 days, showing better liquidity and stronger credit control. So, in terms of credit discipline and cash flow management, Abbas performs better.
I'm Tarsha Ikramnaik. According to our presentation, we compare the performance of two companies, Abans and Single. We will look at the key areas like profitability, liquidity, and efficiency to understand how they are doing and where they can improve. Abans is doing really well in most areas. It makes more profit, which is strong sign that the company is managing its costs and sales better. It also have better liquidity, meaning it is good position to pay off short-term debts. This helps the business run smoothly without financial stress. When it comes to efficiency, Abbas use its resource well. It manage its inventory expense and time efficiency to get the most of out its business operations. Singer is not doing as well as Abbas overall. It does have couple of strengths, like slightly better assets turnover. This means Singer is good at using its assets to make sales. It also has higher return on equity, which shows the shareholders are getting a bit more back on their investment. But there are some areas Singer is facing challenges. In profitability, it's not earning as much as Abans. In liquidity, it might struggle a bit more with short-term payments. Finally, debt. Singer has higher debt level, which can be risky in not managed well. So, what can Singer do to improve? To stay competitive, Singer can take actions. It should try to cut down costs, especially unnecessary spending. It also need manage credit better so customers pay on time and cash flow improves. And very importantly, reduce debt will help lower financial pressure and risk. Thank you.